Most people are daunted by the idea of taking out a mortgage for 25 or 30 years to buy a house. Not the British government, which is happy to borrow money on the bonds market for much longer, up to 90 years in fact. We know this because the Chancellor has announced the UK will repay some of the money borrowed from bond investors to fight the First World War. George Osborne said the Treasury would pay £218 million owed to holders of the 4% consolidated loan issued by his predecessor, Winston Churchill, in 1927. This 4% console gets its name because it paid an annual interest rate or coupon of 4%. It was consolidated because it was used to refinance earlier debts. These included national war bonds sold to the British public in 1917 to fund the Great War. Some of the debt stretched back to the 18th century, when the government of the day stepped in to resolve an early crisis in the City of London known as the South Sea Bubble. The total amount of interest the government has paid on the bond since 1927 is a staggering £1.26 billion, which begs the question, why on earth doesn't the government pay its debts sooner? The simple answer, of course, is the government does repay its debts all the time. There's a special department known as the Debt Management Office to handle the issuance and repayment of bonds so the government has enough money. British government bonds are referred to as gilt-edged securities, or gilts for short, because the UK has a good reputation as a borrower. It's always paid lenders their interest and coughed up their capital when it's due. The vast majority of gilts have maturity dates, which you can see in their names, set at 5, 10 or up to 55 years in the future. So why did the government hang on to the 4% console for so long? The answer is because it could and because it made financial sense to do so. That's because 4% console is one of a small band of perpetual bonds that have no maturity date at which they must be repaid. This is a tiny corner of the gilts market, representing just 0.2% of all UK government bonds. The rest are conventional and index or inflation-linked gilts of either short or long-term maturities. The government kept the 1927 consoles rolling on and on because until recently the 4% interest it paid on the debt was less than it would pay on new bonds. That changed this month when the government got bond investors to lend it money until 2068 at below 3%. The 4% console bonds were also trading above their face value of £100, which meant the government didn't lose money paying them now. Attention is now turning to whether the government will redeem the 3.5% war loan, by far the biggest of the perpetual gilts, issued in 1932 and the only one still available for investors to buy. The other perpetuals are small rump issues which existing investors can only sell to the Debt Management Office. Because of its lower coupon, there's less money to be saved from redeeming war loan today. Nevertheless, there's speculation Osborne could retire this nag as a pre-election gesture to his sound economic management. Over the long term, the government has done well keeping these bonds going. The Financial Times calculated that after inflation, the government was effectively buying the bonds issued at £100 for just £1.82 in today's money. This shows how inflation is the great enemy of bonds paying a fixed rate of interest. That's why index-linked gilts, whose value and coupon rises with inflation, have been so popular since their launch in the 80s. However, Osborne shouldn't feel too smug about consigning 4% console to the history books. If the Treasury refinances the debt with a new bond, it will save the Treasury just £2 million a year. This is a drop in the ocean compared to the £1.46 trillion the UK borrows on bond markets. That's up from £1.36 trillion a year ago and compares to £500 billion or £496 billion before the financial crisis in 2008. Let's hope our great-great-grandchildren aren't paying for the banking crisis in 100 years' time.